Newly filed financial reports are revealing a surprising pattern in how major tech companies are generating revenue from artificial intelligence startups. At the heart of this pattern is a financial structure that critics are now calling a revenue loop. The mechanism works like this. A large tech company invests billions into an AI startup, often in the form of cloud computing credits rather than direct cash. The startup is then required to use those same credits to rent computing power from the same company that funded them. This creates a financial loop where the initial investment is returned in the form of cloud usage revenue. Microsoft's $13 billion investment in OpenAI is one such example. That investment was returned to Microsoft in the form of cloud credits, which OpenAI then used to rent computing resources from Microsoft. Microsoft then recorded those cloud credits as new revenue. This is not a one-off case. Alphabet's first quarter 2026 profit included $28.7 billion in unrealized gains tied to its investment in Anthropic. Oracle's entire $553 billion cloud pipeline is 54% dependent on OpenAI. Together, OpenAI and Anthropic make up more than half of the $2 trillion cloud backlog held by Microsoft, Oracle, Google, and Amazon. This structure raises a key question. Is this revenue truly coming from market demand, or is most people arrive after the move is obvious and the easy upside is gone? We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. It being artificially generated through circular financial arrangements. Critics argue that the AI boom is being driven not by organic demand for cloud computing, but by these structured investment return loops. The financial reports of these companies suggest that much of the reported cloud growth is not driven by external customers, but by AI startups that are contractually obligated to return the investment in the form of cloud usage. This creates a self-sustaining revenue cycle. The implications are significant. If a large portion of cloud revenue is tied to a handful of AI startups, then the financial health of these tech giants could be more fragile than it appears. Slowdown or restructuring in the AI sector could expose these circular flows and impact reported earnings. Additionally, the use of cloud credits as a form of investment return blurs the line between capital investment and revenue generation. This is not just a financial reporting issue. It raises concerns about transparency and the accuracy of corporate performance metrics. As regulatory scrutiny increases, the financial structures of these AI deals will likely come under closer examination. One key signal to watch is whether any of these tech companies face new accounting standards or regulatory actions related to their AI investments. If the pattern of circular revenue is confirmed, it could lead to a reevaluation of the AI cloud sector's financial health. For now, the data suggests that a significant portion of the cloud growth attributed to big tech is being driven by a small number of AI startups, and that the financial returns are being structured in a way that may not reflect true market demand. The stakes are high. If the AI revenue loop is indeed a core part of the cloud computing growth story, then the sustainability of this growth is questionable. Companies like Microsoft, Oracle, and Alphabet may be building their future on a foundation that could shift with the smallest change in the AI landscape. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Raises questions about how much of the reported cloud revenue is actually organic versus engineered. Investors and analysts are now asking whether these AI startups are truly innovating and driving new market demand, or if they are simply acting as intermediaries in a financial loop designed to inflate cloud usage figures. The next signal to watch is how these companies respond to scrutiny. Will they adjust their accounting practices to reflect a more transparent view of their cloud revenue, or will they defend the current structure as a legitimate business model? The answer could determine whether the AI cloud boom is a genuine technological shift or a financial construct.